This 3 ETF portfolio could beat out over 90% of investors, but only if you get the balance right. So I'm going to be breaking down my portfolio that I have for my kids investing with our ETFs, and it includes only 3 ETFs in the entirety. We have the VGT for explosive tech growth, the VYM for that rock solid dividend income, and the VTI. So we do have that total market diversification. Now, here's the twist. Most investors with portfolios get it absolutely wrong. And I want to show you because you could go too tech heavy, get really crushed on the downturn, go incredibly safe with dividends, miss out on the growth, miss out on the compounding. I'm going to break down how each ETF performs, how they complement each other, and how to build a version of this portfolio that is perfect for your risk tolerance, whether you're chasing early retirement or you're looking for long-term wealth with those dividend ETFs. So stick around because by the end of this, you'll see how these 3 ETFs can outperform the S&P 500 with less risk and more income. So let's go ahead and get into it. So we're going to hop over and check out my portfolio here on M1 Finance. Now, I do have a link down below. So if you're interested in investing, and I want to show you kind of what we're breaking down. Now, this is my kids' portfolio. Now, we started early with this, and it has been actually about a year. April 9th of 2014, we started investing. And as you can see, what we're sitting right now is up 34%. Now, looking back at the last year or a little bit over a year that we invested in this portfolio, there are a couple things I would change, and I'll show you exactly why. But let's break down the performance in here. So current value, again, that's $68.84. We can see market gain of over $1,200 in this portfolio. Dividends earned about $100, so not too bad. We're seeing some pretty decent growth in here. And I want to break down all 3 of these ETFs and show you exactly why investing in this portfolio and what percentages, again, looking back, that I would really choose. So for this portfolio, you can see we do have 3 slices here. We have the VD, we have the VYM, and we have the VTI. If you've seen any of my videos, I do love the Vanguard funds. They have an incredibly low expense ratio, but as we can see, the performance of these, the VGT is at a 44% growth, which again is kind of insane. When you think of the last 12 months, the VYM at 23%, which we know is that high dividend yield. Then we have the VTI, which is the total market itself. Again, looking at a double-digit 30% return, which is kind of crazy. Now you'll notice my allocation targets. So when we started this, I put them all at 33. Now for M1 Finance, we did 33, 33. And as you can see, the high yield dividend was the 34, just doing a little bit of a safety play. But thinking of their age, looking back, I would have went a lot more aggressive with the portfolio, and I'll probably go in here and change these. And if you have a comment, if you got to set up, if you're thinking of a perfect percentage in here, it is going to make a big difference on the runway that you have with this. So if you're looking at this portfolio, and let's say, for instance, you are 20, 25, even 30 years old, I would go much, much, much heavier into the Vanguard Information Technology ETF, a lot less in the dividend. And then, of course, our foundation ETF with the VTI, I would keep probably about half the portfolio maybe in there, 40, 50% in here. Now, honestly, my financial advisor always tells me I take too much risk in portfolios, but I want to show you the return of what we have in the benchmark, which of course is very cool to M1 Finance. But first, I want to break down these individually. So looking at the Vanguard Growth Fund, now this is Vanguard Information Technology. The growth in here has done incredibly well. Looking at the performance, money weighted return around 44%. But when we start looking at the expense ratio, this is a reason why I do love how cheap these Vanguard funds are, and they do perform incredibly well. When we look at our VGT details, even looking again, year to date, we're up 21%. In the last year, there's that 25. But then we go to the 2-year and even the 5-year, you can see in 5 years, we are up 139%. Now, I know in this portfolio, there is going to be some overlap with the VGT and that VTI, which again, we'll kind of look at because I want to see the big players within here. So looking at the categories and the allocation we have, these are US stocks, 98% US stocks, 1% non-US. And the top holdings are NVIDIA and Microsoft. Now, of course, because this is growth focused, you can see right here makes up 30% of the portfolio. Now, a lot of people say this is a little bit overweighted when it comes to looking at this and how it is really built out. But again, when we start thinking of AI, when you think of quantum computing, when you think of data centers, when you think of revenue generation, these are 2 of the biggest players that we have within here, making it really important to have a big growth aspect. Again, this is going to be dependent on exactly how old you are. Again, 20s, 30s, definitely heavy into tech, heavy into growth. You got a lot of years and a lot of runway. If you're 50s, 60s, probably a lot less in growth just because you don't have quite the runway. But I would never get out of growth in the entirety. Even if you're looking at a portfolio that is, let's say, of a 50 or 60 years old, chances are at that point, you still have possibly 20, 30, 40 years until you actually pass. So you still need a lot of years of growth out of this portfolio in its entirety, making a really big difference. Now, of course, when we start looking at our next investment, it is the dividend generation. So this is going to be one Vanguard high dividend yield ETF. Now, this, of course, has a pretty good dividend yield, 2.5%. This also does have a pretty decent amount when we look at the actual details into some of the tech. This is the reason why a majority of people do like the VYM over the HD. The HD, unfortunately, that is something that I did sell out of a while ago. Didn't really see the performance that we were looking for out of that ETF. Definitely had to drop that. But looking in here again, 2.5% dividend yield. So it is pretty good. Then we look at the major players in here. We have Broadcom, we have JP Morgan, a lot more financial, a lot less tech, which is important because at this point, again, we don't want a total overlap, but we are still looking at over 96% in US stocks. Now, of course, Vanguard funds, majority of them, even when we're looking at this portfolio, are based in the US market. So there is going to be a little bit of overlap, but this is a lot more focused on the financial and focused on the returns that we see within the portfolio itself. And of course, that means we're not going to have as much volatility. So if we see a pullback in the market, the VYM, you're not going to see as much as a pullback than you're going to see with a lot of IT or information technology or these really big growth ETFs. And then we have the VTI. This is another one. You are investing in the total stock market. So think about all of, and I think it's around the 4,400 companies. You are investing in the total stock market itself. So you have all of your mid caps, you have all of your small caps, and you do have those large caps in here. You can see so far we're up roughly around 30%, which of course is going to make a really big difference because when we start looking at the details of this one, you're going to see very similar to what we've seen in the growth. Dividend yield of a 1.13, so definitely a little bit lower on the dividend side, but you'll see NVIDIA and Microsoft are here as well because, again, there is going to be overlap. When you have anything within the US markets, that is market weighted cap because NVIDIA holds so much of the market weight because it is such a large company. And again, market weighted cap, you're going to have that happen from time to time, depending on what you're investing in. So again, but this includes, and this is where it gets interesting because you have the VGT that again is focused in all those growth stocks. We have the VYM, which is the dividend. This is kind of that income generation. And then we have the VTI, which is again, that total stock market. And again, I broke this up into kind of those even percentages when we built this portfolio last year. And this is where we are going to go ahead and edit the portfolio itself. Now, thinking of my kids, I have a child that is 11. I have one that is 9. This is a portfolio we're going to have for an incredible amount of time. So even looking at the information technology, I would probably bump it up knowing that I have roughly 10-year-olds around 50%. I would definitely back this off quite a bit just because the income generation, I'm not really too worried about that right now when it comes to the income generation, even if we did like 15 and then possibly bumping this up to about 35. Now, for me, I know this is aggressive, but when you think of this portfolio, it is not for a retirement portfolio. And even if it is right now, think about the full retirement age, which is usually around 65. If we have a 55-year runway to invest in this portfolio, it's going to be kind of crazy, especially with the growth factor in here, also having the total stock market. So even if there is a big pullback with tech, we're going to be protected here with our high dividend yield and protected, of course, by the total stock market itself. So we're going to go ahead and save this. Now, one thing to note, there are 2 different ways when we can from the update in here is you can rebalance the portfolio in the entirety, which I am not going to do because as you can see right here, our percentages are going to stay the same. The rebalance is going to happen over time through dollar cost averaging. Now, this is a portfolio that I do add funds into every single 2 weeks. So every 2 weeks, we are putting more money into our kids' investments, into the kids' portfolio just on a regular basis. Then when we have money for birthdays, for Christmas, whatever it is, we're throwing it in here as well. This money in its entirety is completely for my kids, which again, as we start generating income, as they start getting a job, as we start making contributions for the kids in here, it is going to grow to a point of if they need a new car, if they need something else like that. If we use it for just a straight retirement fund, again, thinking about in here, just the growth factor on almost 7,000 over the course of 55 years, you would see an absolute crazy amount. But like I said, with the rebalance, I do not rebalance my portfolios. So through my contributions, because you can see right here, VGT is now at 34% versus the 50 is the target. It will automatically put it into the target that is the lowest. So again, it is going to use a mathematical computation to go ahead and even this out and getting those lowest percentages up higher through the contributions. I don't want a possible taxable event. If I sell out of the VYM, I want to keep the portfolio as it sits today, and being able to build up these big growth funds a lot faster is really going to make and be a driving force when it comes to building out this portfolio, which is what I absolutely love. So guys, M1 Finance, again, this is where I do all of my investing. I do also have Robinhood. We got some links down below, but this again, through rebalancing or through the contributions, it's going to automatically rebalance in the portfolio. Definitely a good portfolio overall. And again, if you're a younger generation, 50% in growth, I feel like if you have that 20, 30, 40 year runway, the growth makes sense. Now, for me personally as well, I have two things and two rules that I personally really go by. Number one, I do not invest into anything international. It is a personal choice. I do not put anything into international. I know there's been a couple years where they've outperformed, but honestly, those are accumulation years or years where we see a market pullback that I have the ability to put more funds in here. And I do not invest in bonds. Me personally, I would rather have something like the VYM right here yielding a 2.48% than investing in bonds, because this one, we also do get a pretty good growth rate out of it. And again, we don't really see it for bonds. So even though it is a smaller dividend yield and a smaller income generation, I still like the growth factor that we do see within these. And again, thinking of an extended amount of time, I feel like the dividend or the income generation really does make sense when it comes to a supplement for like an early retirement, possibly doing like a supplement to Social Security or something of that nature. But all right, guys, so that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.